everyone, welcome to a new video on RRG, relative rotation graphs. At the end of the week, not intentionally, sorry to be late. It's a lot going on this week and I still want to sort of address that in a short video. For this episode, I want to first of all dive into what's happened to the markets in terms of where we are with SPY, but also where we are in terms of current sector rotation. And then, because it is the end of the month, I want to go back to the seasonality and the, call it, new tool that I showed you about a month ago. I got quite a few responses to that approach. Most people seem to like it. And there was someone who gave me a good suggestion, and I thought about it. And I hope I've sort of implemented it in a way that it gives even more information. So, no time to waste. Let's get started. Obviously, we have to start with the current RRG and the rotation that we see there for US sectors. This is a weekly chart, so it doesn't change that rapidly. But having said that, you can see that this week and the last segments here are updated until, in this case, Thursday's close. I'm recording this Thursday after the close of the US markets. So you see that these segments are generally a little larger than what we've seen over the last few weeks. That means that there is movement going on. And we also see that that movement is, say, negative for consumer discretionary and technology. Those are the two sectors. Obviously, they're the two biggest sectors. So that's why the market is getting hit hard, because the large stocks are in these large sectors. So that's why NASDAQ and S&P are taking quite a big hit. If we step back from that day-to-day noise and we look at the state of, in this case, the weekly rotation, and we see that communication services is still inside the leading quadrant. It's actually managing to hook back up last week. So it's kind of abolishing this negative rotation and hooking back up. And you can see how financials are now rapidly improving. Look at that last segment, how that is improving. On the other hand, we see technology moving out of favor and consumer discretionary. Although it's still inside the weakening quadrant, it is at a negative heading. Still the possibility that it will curl back up, but we do need to see a lot of improvement over the next couple of weeks for that to happen. The improvements are pretty much all on the other side, except for technology, but all of these tails are turning up. So industrials, utilities, energy, staples, real estate, materials, healthcare, they're all pointing into that northeastern direction, that strong RRG heading. So there is a shift going on. If we look at the daily RRG, let me update that chart to the daily, then you can see even bigger moves. So this is the move of the last 5 days. It's pretty much this week. And you can see how consumer staples is outstanding. That is obviously, markets going down, and you will expect defensive sectors to take the lead, and that's exactly what's happening. So consumer staples picking up. You also see utilities picking up, although that is, the last 2 days, 2-3 days, very stable. And you also see healthcare. Those are the three traditionally, let me highlight them all here. So these are the three sectors that are traditionally seen as defensive, and those will shine when the market is under pressure, as a situation as we have right now. The other sectors that are picking up, definitely energy, materials, and here is financials, the move in financials. And you can see how communication services is inside the weakening quadrant, but compared to all the other tails here, this is relatively short. And you know that a short tail means that it is a stable relative trend. And in this case, because communication services is on the right-hand side of the chart, that's a stable relative uptrend. What does that do for the S&P 500? Because this picture, if I look at this picture, it's still mixed. The short term is definitely pointing to defensive sectors. So we may see a little more defensive action decline in the S&P 500. If you look at the weekly RRG, then the financials is definitely not a defensive sector. Neither is communication services. Neither is consumer discretionary, although this tail is not very promising, but there is still plenty of time for discretionary to move back up. So stepping back and looking at the bigger rotational picture, I feel that what this is telling us is that we do see some sector rotation, especially on the daily time frame, but it's kind of mitigated by what we see on the weekly time frame. So they're in some areas contradictory, and that corresponds with a market with the S&P 500 or SPY being more in a sideways trading range, which we discussed, I think, over the last 2 to 3 weeks, that the momentum was out of SPY, but it also wasn't super negative. That long-term uptrend is still there. So let's take a look at the current chart of SPY. Here's the chart of SPY, and you can see that we tested that overhead resistance around 610. We discussed that a few times. Then we broke that rising support line, which was a first sign of weakness. And then we hovered above this area of support around 590. We bounced up 1 or 2 days. And then today we actually broke this support level, which is around 590, which was the in-between low between those two highs. So I'm going to say it's not really the characteristics of a double top, but it is double top-ish, I would say. So we're now resting at, I'm going to call this an intermediate support level around 585. And then there is a gray area between, I'm going to put this, 575, 580. So this is roughly every 5 points to the downside, there's some sort of support. The big number here is 565, I think. But before we're there, we will see a number of support levels coming in. This is not a market that is ready to crash and lose the bottom, because if you look at the longer term charts, you look at the weekly, then we still see this rhythm of higher highs, higher lows. There's a bunch of divergences. I think that every technical analyst is looking at those and writing about those and blogging about those. I totally agree with the negative divergence in the MACD. Not so much with the RSI, because I think that divergences in the RSI should take place at high levels, above 70. And that's not the case here. And even between the two peaks, it rotated below the 50 level. So the negative divergence in the RSI, I'm not too much on board with that. I am on board with the negative divergence on the MACD. So there is definitely some room for downside there. What are we looking at? As I said, the first serious level here on the weekly is probably 575. Then we're looking at 565. If that breaks, that's going to be, pretty negative. But then we still have that old rising resistance line moving higher, which should act as support. That is way into the future. For the time being, I think that, yes, that SPY is caught in a trading range between 575 and 610. And if 575 breaks, then this can be seen as a double top, because this is literally the end of a trend, and double top is a reversal pattern, and that takes place at the end of a trend. So this could be a trend ending signs when we break below 575. That's my kind of line in the sand. If that happens, we will probably see a little bit more, or quite a bit more, downside in the S&P 500. For the time being, I'm watching support around 575. Let's take a look at seasonality. I have taken a different approach than what I've been doing last year and the year before. If you have missed the last video of January, and let me find that for you. If you go to the RRG playlist, my playlist on the Stockcharts YouTube channel, you will see watch for these seasonality patterns in 2025. If you haven't seen this video, please take a look at it and you will understand what we will be talking about right now, because I explained there how I came to these seasonality patterns and data series that I'm going to use in this video and going forward. I told you that I wanted to try to get these seasonalities which I have now updated on my PC and my Stockcharts account as a UDI, as a user-defined index. But I can't share a user-defined index. It's for personal use. And I wanted to, instead of sending all of you the data and you have to create your own UDIs for that, which I could do. It's not too hard, but it's work. You need to do something. I am trying to get those as ticker symbols on the Stockcharts platform. We tried it and it kind of works, but we found out that it causes errors in some other areas of the site, which are not happy with dates in the future. Technical analysis typically deals with dates in the past and what has happened. This is forward looking. I'm sure we're gonna work it out. If you really want it, I'm very happy to send you my data files so you can upload them in your own account as a UDI. Otherwise, please exercise a little bit more patience, and we'll get them up there in the next couple of weeks. I'm pretty 90% sure that we should be able to do that. S&P 500. What you're looking at here, the bar chart is the current price of the S&P 500. The candle chart here is the seasonal pattern based on 20 years of history. And what I've added after that video is based on a comment. If you look at the comments in that video, someone says, you could even do better by detrending that seasonality chart. And I thought about that. I was like, yeah, detrending, but we really do want to see the trends that are typically occurring. That's the whole idea of seasonality. You want to find the seasonal trends. The issue is that the magnitude of those moves over time can vary greatly. Sometimes, even if you just look at S&P 500, sometimes market moves 20%, other year it moves 5%. And it could be moving in the same seasonal pattern, just with way bigger magnitudes. And if you start looking at detrending, you can do regression analysis, you can take differences with moving averages, and there's a whole way you can sort of detrend a time series. And I like to keep things simple. So after giving this a little bit of thought, I thought, you know what, I'm just going to throw a rate of change on it. And that's what I did here. So I've sort of detrended this seasonal pattern with a 12-week, 1/4 rate of change. And that should give us a pretty good idea about where those sectors, or in this case, the S&P 500, is about to peak and bottom. And remind you, this is not an exact science. Seasonality is not an exact science. It will never be exactly on the date or the week that was the average. It's an average anyway. So please use it as a very rough guideline to give you an idea of what you could expect based on 20 years of history, condensed into the seasonal pattern in that candle, and then the rate of change of that seasonal pattern. And just give you a little bit of background and foundation of forward-looking ideas. Let's put it like that. So the way I'm looking at this is that it was to be expected that the S&P was going to be under pressure, because if you look at especially that rate of change chart, shows that very nicely. You see a peak at the end of the year, and then it moves down towards mid-March. And if you look at this here, this is a kind of sideways period. And in a way, the market in reality actually, followed that pattern. We didn't do much since, in this case, the 2nd of December. We tried and we peaked mid-Feb, but we didn't really rally. And that's what this pattern was telling us, and that's what the rate of change here was telling us. So far, S&P under pressure is not a surprise from a seasonal point of view. What we can see is that based on the seasonality pattern, we will very likely see some sort of a bottoming between, let's say in the first half of March, maybe somewhere in the month of March, we're going to see some form of bottoming followed by a new rally. Now, because these are averages, it is not this could go down and move up with this peak not moving beyond the prior peak. That is something that you need to keep in mind. That's why the rate of change can help you to pinpoint and see like, hey, there is something going on, and you may see a toppish characteristic somewhere in May, June. Then that rate of change of the seasonality could help you get a little bit more confidence in any analysis at that point in time. Let's quickly go over the individual sectors, and we're going to do the rough seasonal. So this is the price seasonal. And then we're going to do the relative seasonal. We can't do a relative of SPY versus SPY. That doesn't make any sense. But we can do it for each and every individual sector. So I'm going to do this really fast, because otherwise we'll be talking for hours. And that's not the aim of this video. So here, materials. Very early peak. If you look at the seasonal pattern, we expected a peak somewhere at the start of the year, and then a little bit of sideways. This peak in materials, I think, has come very early, and then we saw that sort of consolidation, and we saw that rally, and now we are a little early, because this bottom here sort of coincides with this and this rate of change bottom, which means that materials could be in this phase here where we've already started this move up. It's not the best seasonal pattern around, I have to admit. The next one is the relative of seasonality. So again, I'll explain it for this particular chart, and then going forward, you will see the same picture for every sector. So here is the seasonal relative of materials versus SPY. So the seasonality of materials versus the seasonality of SPY. This gives you the average movement. This is reality, and here you can see a very good example of how big the difference in those moves can be. And to get to the detrended part of it, where you will get a better handle on where the peaks and troughs are expected, you can see here that this decline here, I am inclined to say that this peak is this peak here. So that came very early as well. And then you sort of bottomed here, which is this low here. And then we're in a bit of a doldrum period until the end of March, and then we will get a hiccup and then another decline. And then the best part for materials will be towards the end of the year. Here we see communication services. That's a good example of this is why you want to have that rate of change picture there, because this is 20 years, or communication services a little bit less because we don't have 20 years of history of sort of stellar performance for that sector. You also see that the pattern that we've seen so far quite nicely follows that seasonal pattern. What we see here is that we are in a period where seasonality seems to be under pressure. It started at the end of December, and then until kind of now, we're going nowhere. And then you see a little bit of a dip here and a broad period somewhere that spans the entire month of March, where we could see a bottom forming followed by a new piece of the rally. And if you bring that in your mind, a mental memo to the RRG, where you see communication services, which kind of hooked up but was rolling over, could be in that sort of doldrum, sideways, non-trending move. And that's why XLC on the RRG has a relatively short tail. If we look at the relative performance of communication services, then you see that, again, I'm thinking that this was early. So we bottomed early, we rallied, and we're now running into this period here, which is a couple of months, where the relative performance of communication services is moving a little bit more sideways. You see that pause in that relative trend as well. And that could actually take quite some time, because it only is, starting to really rally somewhere in the second half of the year, with a peak expected somewhere in July, and then bottoming out again with this sort of, it looks like it's in an uptrend, but if you would sort of put a square or a rectangle around it, there's not much going on. Here is energy. This is a very volatile period in reality, and much more volatile than what you would expect from the seasonal pattern. And what we see here is that we kind of bottomed in September. We had another rally with a decline, which is probably something like this. And then we see a decline at the end of the year, which again looks like all these cycles have bottomed a little early. And we're now in a period where we can see a market bottoming, moving sideways. So energy is in that same boat. If you look at the seasonality, looks like we're a little late because we are underperforming. We're still underperforming. This is the relative strength of energy versus SPY. And it should have been going up, or at least that was the rate of change assumption. We see the bottom in relative strength aligning with this one here, aligning with this one here. And if you want to, if you want to see the positive things, then we are aligning here, and we're now kind of moving higher a little bit and then leveling off at a higher level. So from my point of view, the way I read this, the energy sector is not in too bad shape for the next couple of weeks. Here is financials, and we saw that tail of financials moving higher inside the weakening quadrant. And I think that's exactly what you see happening on the seasonality pattern. There's this expected bottom here. We are a little early, but any bottom here is coinciding with this. It's coinciding with the bottom in the rate of change. And when you look at the relative strength, then we are actually moving higher. We may need to see a little consolidation, because that's what you see right here. Maybe we bottomed early, and this is the bottom here, but we're in a period where any relative bottom for financials, I think, is a good point to look for a further outperformance, which will last somewhere until, I'm going to say May, maybe even June. Here's industrials. Again, looks as if it has peaked a little early. We've seen a decline here, which I think was coinciding with this. And then we see we're right now moving into a low, and you also see the rate of change moving into a low. So the industrial sector, although it is under pressure right now, expected to bottom somewhere in the month of March, and that is the next 2 to 3 weeks. And all of that's what you see in a lot of those relatives and a lot of those seasonals, that we see bottoms coming in the second half, or in halfway March. Translate that into a SPY chart, which is now trading in a range, more or less sideways, maybe a little bit more downside, and then bottoms and sets up for a renewed rally. In the end of the day, it's all trying to look forward, trying to make sense of the historical data that the market throws at us, but it's all we've got. And we always have to realize that it is the current price that is what we have to buy and sell against. So whatever seasonal, whatever forward-looking, whatever analysis we do, we got to pay the price that's on the screens at the moment. Here is the seasonal pattern for industrials, and you can see how the seasonal has already sort of started bottoming out, which I think is aligning with the bottoming process that is expected somewhere in March. And you can see how it's aligning with the seasonal trend here on the main chart. So again, a sector that looks to be bottoming out in the coming weeks. Here is a little bit more negativity. XLK actually broke lower, broke the in-between low. So that's a pretty negative signal. We have seen that before. Pretty much every year on average, we see this. This is quite a severe move. And this is what you see here. And again, we see this bottom. So what I need to wait and see is whether the real price still has to make that low. And if I just go on the price chart, I'm going to expect that this might actually be a little lower than the average move, so a little bigger move than the average move. But we will see the market picking up again after March, April. If we look at the seasonals, then we can see that the relative is actually bottoming not until May. And that is, again, if you would draw a rectangle around the relative, the seasonal pattern here, you wouldn't see much of movement. And that's why that rate of change is actually moving lower, because there is not much upside movement. Hard to tell, but this bottom in technology, from a relative perspective, might come a little later than the other sectors that we have seen. So I'm going to say a little bit more careful with the technology sector, which again sort of aligns with a neutral view for the S&P 500. Because last year I did a few articles and videos on whether the S&P would be able to rally without the participation of technology and consumer discretionary. And the answer is very, very difficult, because these sectors make up so much of the market capitalization. What the best that can happen is if tech and consumer discretionary are under pressure and keeping, if they go down, then it has a big effect on the S&P 500. So all the other sectors then need to step up and improve, but they can only do so much because they have a lot less market capitalization than technology and consumer discretionary. So that's a bit of caution there for the technology sector. Here is consumer staples, just breaking out, looking very, very good. And you can see here the bottom. I think that the bottom for staples came early, and this is the bottom, and we're now in this up move for the consumer staples sector, which could actually last a little bit longer, which aligns with the narrative that I just explained on a SPY moving sideways without the participation of consumer discretionary and technology. And here you see that the relative strength is pretty much on target with the bottom in relative strength based on the rate of change. And you can see that right here. And if that continues, then we will see outperformance for the consumer staples sector pretty much going into May. So that's like 2-3 months. And again, even when the seasonal pattern for consumer staples is flat, if SPY goes down, that's an outperformance for the consumer staples sector. Here is real estate, a little bit less history, but here you can also see that we've already sort of set that bottom. Maybe that's this one, and maybe we're now looking for a low into the say the March dip. But we've already seen a bit of a decline here, and this is a rally back up. For me, sector that is hard to read at the moment. If you look at the relative strength, that's a much clearer picture. And you see that on average, the rate of change, so the movement of the seasonal pattern for the real estate sector, is actually pretty good until May. So sort of this bottom aligns with the bottom, these two bottoms here at the end of the year. And we're now in a outperformance phase and outperformance period for the real estate sector. Here is utilities, also a strong sector from a relative point of view at the moment with the market under pressure. Here also, again, it looks as if this whole chart is shifted a little bit to the left and the movements are coming in early. And if we look at the seasonal pattern, we can see a similar pattern to what we saw with real estate, that is this relative bottom looks as if it came a little early at the end of last year, but it coincides with a relative bottom around the transition into the new year and then moving up until May. And again, here you see it looks as if nothing's happening with that flat move here from a seasonal point of view. But if you basically the rate of change is magnifying that with taking out the trend, you can see that we're actually going into a pretty strong phase for the utility sector. And then here is healthcare. Same story. Seems that a lot of these moves have come a little early. It means that we have to make this decline. Maybe this is the decline already, and we're moving into this low. And then, within a couple of weeks, we would see healthcare picking up. If we look at the seasonal pattern, then we're pretty much on target and we're moving higher. And that's interesting because that means that healthcare is about to set up for a decline or an underperformance, so a decline in the relative from a seasonal perspective, which would mean out of defensive, because healthcare is one of those defensive sectors. So you hear that there's quite a bit of contradictions, no one clear trend, neither in SPY, neither in the sector. So that, for me, that it makes sense with that sector rotation going on for SPY to remain in limbo into that sort of sideways move. We'll have to wait and see how that works. But right now, I'm not too negative for SPY. I see the sector rotation going on, and not giving a very clear signal, so to say. Here's the final sector. This is consumer discretionary, together with technology, the ones that are keeping the market under pressure right now. This, for me, is pretty clear double top formation, so we need to execute that. It has been executed, and we're moving into a new lower. We're going lower. We have this low right here, which is at the start of the month of March. That will be next week. I think that this pattern calls for a little bit more downside price action. So I wouldn't be surprised if this takes a little longer, and we will see a bottom in consumer discretionary past the seasonal bottom. But after that, we will see a rally again, a period of outperformance for the consumer discretionary sector. If we look at the relative performance, then you can see, again, here, this is generally moving higher. You see the really strong move in consumer discretionary as it happened last year. We're now in that decline coming out of these highs, moving into the low here in Fab. And what I just said in terms of the price, I wouldn't be surprised that this underperformance takes a little longer. It takes a few more weeks to pan out. If you remember where XLY is on the weekly RRG, if this works and it doesn't take too much time for that relative low to get into place, we could see that XLY tail curl back up inside the weakening quadrant and start pointing up again. And that would be a very good support for the market as a whole, because then consumer discretionary is back on track for outperformance of the S&P 500 and back on track for that seasonal rally that we would expect based on the last 20 years average. And that wraps up this week's video. Took a little longer than I expected. I thought it was going to be something like 20 minutes, but we're over 33 minutes. Sorry about that. I hope you stayed all the way until the end. If you did, thank you for watching. I hope you enjoyed it, and please let us know in the comments any feedback you heard. I listen, I read it, and I think about it. And if it makes sense, I try to incorporate it. Thank you again for watching, and I'm looking forward to seeing you again next week. I'm gonna say same time, same place, but it's a little bit volatile lately.